In 2021, the S&P 500 had a total return of 28.7%, which was the seventh highest gain in the past half-century. Since this was the third consecutive year of double-digit returns, many analysts now believe the stock market is due for a correction. One of the main arguments used to justify this more pessimistic outlook is the fact the Federal Reserve is expected to raise interest rates 3 times this year in an attempt to tamper the inflation we're now seeing, which is at its highest in 40 years. As interest rates rise, assets such as treasury bonds become more attractive to investors who, up until now, have had to buy stocks to get any real return. As a result, stocks sometimes fall when interest rates increase. This is exactly what we saw in early January when the 10-year Treasury yield rose as high as 1.8%, causing the Nasdaq 100 to drop 4.5% in a single week. It's clear that unlike the past few years, when investors were more focused on the growth story behind a company's stock, investors will be looking more closely at the fundamentals of the companies they invest in. This is one reason why Peloton, which was shockingly able to temporarily achieve a market value higher than Exxon during the pandemic, has fallen by over 80% from its peak. However, just because investors are being more selective in their investments does not necessarily mean that we will have a large correction like some of these market analysts believe. History shows that the good times can sometimes continue. The S&P 500 returned more than 21% for 5 straight years between 1995 and 1999. History buffs know that in 2000, the stock market did finally crash, losing nearly 50% of its value. But that's a story for another time.